it's interesting, just every trend is in Texas's favor. So I'm not surprised to hear what you're saying. A lot of these relocations, they announce them like a business relocation, but they don't just move immediately. It's like they announced it in 2020, but they actually are going to move in 2023. So then they're still ringing Levi's phone, or your brokers, I guess, probably, but about moving.
Yeah, certainly.
So yeah, that all makes sense. And so I got the reasons why you invest in it. We have a lot of passive investors that listen and watch. So what would you say like your investors are looking for? Because I think they're probably not saying, I like how high the untrended yield on cost is, or what we were talking about before. This is like they're looking at this from a different angle. So what have you heard? What do they like about investing in industrial? I'm Drew Brenneman, and this is the Rise and Invest podcast. I bought my first 2 properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor. All right, welcome everybody. With me today is Levi Benkert. Levi is the founder of Harbor Capital, a real estate private equity shop that specializes in industrial properties in Texas. Levi and we met over Twitter, so excited to have him on the podcast. Welcome.
Yeah, thank you. It's fun to be here. I'm excited to get a chance to do this.
Yeah.
I feel like I know you because we've connected on Twitter so much, but haven't actually seen you. So, yeah.
I know. This definitely feel like I know you well, too. And yeah, the first person that I ran across that we both bought properties when we were teenagers. So I remember seeing you tweeted that you bought something when you were 18, 19 or something. And I was like, wow, someone else did that.
Yep.
So
yeah, very awesome. brave real estate agent. My wife and I got married real young too. And then I think we'd been married like a month or two. We just walked into a real estate office and we're like, we want to buy a house. And this guy, I still remember him, Brian McMartin. I ended up buying a bunch of houses with him. He was like, sit down. We'll try to figure this out. I don't know if it's possible, but we'll certainly try.
Yeah. And like what year about was that?
It was, so we got married in December of 99. And so it was 2000, like February, March of 2000, where we walked into his office. He was like, how much money do you have saved up? We were like $2,000 maybe. We could probably get a little bit more, we'll save between now and when it closes. And he's like, okay, well,
dang.
We'll see if we can make this work.
Yeah, I got started in 2004. So then, it was a perfect time where I actually had income you could document and like a plan. So I was already, a step ahead of half the borrowers at that point with their no doc loans and whatever else they were doing back then.
Yeah, that's funny. Yeah, we used a couple of like down payment assistance programs that basically would burn off. So they gave you like 3% of your down payment or something, and it would burn off if you kept the house for more than 5 years. But we only kept it for a year, so we ended up having to pay that back. But incredible like programs. I remember it was an 8% interest loan. So even though it was like I think we paid $92,000 or something for the house, we still had a fairly expensive mortgage.
Yeah,
it's like $1,200 a month or something, but.
Nice. Well, great. Well, yeah. Well, so actually the topic of today's episode is not going to be how to do your first deal, but maybe we should do that one later. But so far, really every podcast we've done has been more or less about multifamily real estate or just maybe more just real estate in general. And Levi, he does industrial, like I mentioned in the intro, and really haven't talked about industrial so far. I know the asset type well. I bought one deal in 2010, an industrial deal. It's been great. We still have the same original 2 tenants in it. One of the tenants was a post office sorting facility, or still is one of the tenants on a 15-year lease. So we really haven't had to do anything since we bought it almost. It's been a great deal. So I know the product types, but I want to start with like more of a basic kind of what is industrial, and then get into what Levi focuses on and how things are looking today. So I'm going to ask some questions that might seem basic, but we want to, just if you're not familiar with it. So
no, that's great. It's funny. My joke, but it's not even really a joke. Every party I'm at, people ask what I do, and I say industrial real estate, and they kind of gloss over like, wait, what is that? What does that mean?
Yeah.
All right, let me dive in.
Yeah, and there's a bunch of different types. Yeah,
absolutely.
So even if they think one thing, like, oh, it might just be this like a bunch of little garages, like, okay, maybe that is one part, but also there's, these gigantic sorting facilities that, FedEx and Amazon take down too. So there's like a wide range of what does that even mean. But cool. Well, yeah, maybe if you want, let's just give maybe a quick intro on yourself, and then let's get going on industrial.
Yeah, so I've been a real estate GP of one sort or another for the past 21 years. Did my first deal that I raised capital on back in, I think it was 2002. Raised money. I was real young, raised some friends and family capital, and turned a profit and paid everybody back, and thought I was Superman and I could keep doing this. Kind of throughout the years did that. Had a rough 2008 was rough because I owned a bunch of multifamily lots that were ready to be built, meaning I'd already put curb, gutter, sidewalks, storm drains in the ground and paid the fees to build, but then wasn't able to build because the banks came and said, hey, we're pulling all your construction loans. We like you, but we don't like the market, and so we're not going to do this. And so figured out the hard way, kind of how bad the market can get, but learned so much. I mean, if I had to do it again, I certainly would do it differently, but also I'm very thankful for the lessons learned through that period of life. Started a multifamily development company a couple of years later, sold that in 2019. Sold it, had a $1.1 billion pipeline of projects that were either under development or already, land secured and ready to get started on. And then started Harbor Capital. So Harbor Capital's not even 2 years old yet. We own $120 million worth of industrial real estate in Texas. So only Houston, Austin, Dallas, San Antonio markets. We are obsessed with these cities and the synergy between those cities that creates this, of course, a recession is a recession, but it's by no means evenly distributed. And we're finding Texas to be incredibly resilient and still seeing a lot of growth. And we like that and are thankful for that. But we buy, and when I say industrial, what I mean is typically Class B, meaning it's not brand new, not super nice, but still serves the same function of what a brand new building would serve for a tenant. Our tenants range from manufacturers who actually do manufacturing out of our buildings to warehousing, and they store on pallets or racks lots of equipment or supplies that they ship out. And we even have, I think we sold one recently that was a gymnastics facility, and so kind of whatever needs tall ceilings and wide open spaces, we will lease to them.
Keep going.
Our typical play or playbook, I guess, that we'd like to run, that we've made really the most money on, is buying a vacant building or something that's severely underleased and figuring out how to reposition it, doing some tenant improvement work or work before we have a tenant to get it ready, and then leasing it. It's an incredibly inefficient market, which I really like. That's one of the things that pushed me away from multifamily. Is there's a lot of players in that market, and so therefore a lot of people who kind of know the value of a building. We often acquire buildings where the seller just didn't know what it was worth or didn't know it was potential, and we're able to come in and add that value. And sometimes it's 40 or 50% higher than we paid for it. We like that.
Yeah, it's an owner user. Maybe they bought the building for their business, and then you contact them and they could lease it back from you, or they're done with it and they're not really in real estate per se. They just own this one building. Yeah. So that makes a lot of sense.
Yeah. I always joke that if it wasn't for baby boomers, we wouldn't have sellers, because many of them bought buildings and kind of didn't know what they were doing, but they were smart investments for a little while, and now are just kind of stuck holding the bag and getting ready to retire, and excited when somebody comes along and it's like, I'm a real buyer. We've got real capital here, and we're ready to help you move on to the next phase of life. And
yeah,
that works.
Yeah. And then, so just kind of, how would you describe what's just an industrial building? So I know you were talking about things, tall ceilings, but what else would one of these industrial buildings look like?
It's kind of two different formats when you break it down. There's obviously a lot of nuance within them, but it's either dock high doors, meaning a semi truck can back up and, the ground height is right at the height of the truck. And so you can unload and load the semi truck with a forklift without having to have a lift or a lift gate. Or there's ground high doors, which are, obviously a different type of use. And so for manufacturing, it's always ground high doors, and maybe there'll be 1 or 2 dock highs. And for warehousing, sometimes we've got buildings with 25 dock high doors on them. That's kind of the 2 major distinctions. Height makes a big difference when you're talking about racking. And so it's always, 2, 3, or 4 piles high of racking systems. The taller you get, the more, obviously it's not just the ceiling height, but also then the fire sprinkler system needs to be upgraded pretty significantly to handle just that much more flammability, or flammable product that can be stacked there. It's amazing how much more expensive that fire sprinkler system can get.
Yeah, there's just big boxes with tall ceilings and and docks to pull trucks up to. So yeah, and then certainly, once you get going in it, I got a buddy who works for Nuveen, and you ask him, what do you want in an industrial building, and he's got you got to have the dock high loading, cross docking, this and that, like where there's a lot of nuance to it, but to keep it simple, it's like these are not your prettiest buildings in town, but that's where like your average company is gonna be working out of, where they need some sort of storage or sorting space, or they have actual product they need to move. Not everybody just works on a computer all day. And then this is where they go. So then what are your tenants like in these kind of buildings?
That's one of the advantages that we've figured out how to position ourselves into, is basically setting up really conservative financing structures, which basically just means we have very large reserve funds and low debt on our deals so that we can wait for the right tenant. And so we recently bought a big 135,000 square foot building vacant, and put a structure together where we've got multiple years worth of reserve funds set aside, so that we don't have to rent to the first tenant that comes along. Because the difference between a local kind of brand new startup that has weak financials and maybe 6 months or 3 months worth of debt service cover, lease coverage in the bank, compared to leasing to a publicly traded company that's not going to default on the loan, the difference in value in a building, depending on the tenant, can be 30 or 40%. I mean, we buy buildings and then we sell leases. Basically, when we turn around and flip, if we sell something that we own, we're basically selling the quality of the lease. And that quality of the lease is largely dependent on our ability to sit and wait and negotiate. If we're desperate and we're, looking at those mortgage payments every month, like, crap, this thing could go sideways real quick, we need to get out of it, then we're much more, negotiable, and we don't want to be that. So.
Yeah, I mean, that's good advice really for anybody in any commercial property, because what's interesting, maybe if you're watching or listening and you've invested in, let's say, any sort of just residential property where, like you're not, a lot of times in these commercial deals, you're not really picking your tenant, in a way you have, it's for lease. And then a lot of owners, they just will take the first respectable company that comes in through the door. And it's like, oh, I have this shopping center and I used to have a bank there, but now this restaurant wants to come through and they'll do it. Like, okay, like that's your only sort of application, if you will, like at that point. So then that's a really good point with commercial, where if you want to be able to pass on certain tenants and wait for the right one, you got to have a lot of reserves, because obviously an empty building or half empty or whatever it would be while you're waiting, it's not making any money at that point.
Which then you kind of take a step back and look at what does it take in order to put those reserve funds together. For us, we use some of our own capital, but also raise money from investors. And we basically need investors to agree that they're going to kind of overfund this deal, which means it's going to have lower potential returns for them. And that then comes back to reputation. How trusted are you? How, much of a good operator, and what's your reputation? How much do people see you as somebody who knows what they're doing, to be able to be willing to accept, this might be a 3 or 4 points lower IRR projection, because we're going to have a $2 million reserve fund that sits there largely unproductive. We'll often stick those into a CD or something just so that they're earning a little bit of interest, but they're really not productive.
Yeah. Or if if you don't need it, then it's like, it's $2 million you invested, and there's no, like, the multiple on that is just, it's one, you just get it back. Like, it doesn't help your deal any, if you end up not needing it. What are you, and then that's a good strategy though. Cause one thing with these commercial deals, and I've kind of wondered how people set them up. So you raise money mostly from individuals. Is that right? Then,
yeah. All of the above: high net worths, family offices, individual investors, and big institutions. Kind of every one of our deals has a smattering of every different one in them. So we have 1,100 LPs who are accredited that are on our list that receive our deals, and we typically fill up real quick. It's one of the beauties of having delivered strong returns is people keep coming back and giving us their money. So.
Yeah. And then how did you build up that list of 1,100 then?
Over the years, really. I mean, like I said, Harbor Capital started recently. We've had an incredible run up of, buying in quite a bit of real estate in the last year and a half. But it wasn't that we started from zero. There were family offices that had done many deals with me in prior businesses that I had started and had successful exits and kind of knew what we were capable of doing and were willing to take that chance. I mean, that's not to say those first deals, it was kind of, they're looking at me sideways like, wait a minute, industrial? I'm explaining to them. So I've done some industrial deals before. I do have experience in this. And, from a structure standpoint, it's the same. It's just that the property is a little bit different. But,
yeah. That makes sense. Because one thing I've always wondered, especially where if, let's say, it seems easier if you have like one or two investors in a commercial deal where they really, maybe they I would say it feels like at times like they understand the plan better of what this business plan is going to be. And then like they might know, okay, if we don't land this tenant, we're going to need to add money. And so it seems like since you have quite a few investors in any given deal, like your strategy to avoid having to add money if the hold is longer is just to plan like what's sort of already the worst case scenario for how long this will sit when we need to find a tenant, and then just, I'm sure, budgeting for max commissions and tenant build outs, where then you're not, because the reason you're funding all that up front, you're trying to avoid going back to the investors and say, actually, we need another year of carrying the building and we need more money, or what's the...
Yeah. I mean, it's, you kind of can't predict what the future is going to bring, and we want to be ready for anything. And I hate capital calls. I've had to do it before on deals when the market turned. And, I think I put a very high value at sleeping at night, and I think our investors do too. And so we basically just go to them and say, hey, we want to ask you to take this deal that's potentially going to have a lower IRR than it would if we'd levered up and raised less equity. How do you feel about it? I mean, it's funny. We always kind of say that, but then we've sold 4 deals. Well, 2 of them sold already. 2 of them are in contract to sell soon. And our IRRs are 112, 63. And then the 2 that we're selling are, one's a 60 and one's are better than 60 and better than 50% IRR for investors. So certainly delivering good returns. Even all of those had big reserve funds.
And on those deals, those are all, I guess, if they're Harbor Capital deals, those are 1 or so year holds. Then just how it worked out. Yeah,
I mean, those ended up all being 1 year holds, and that's not necessarily our primary strategy. But there's a certain type of building that you've kind of extracted all the value out of it that we want to, and we'd rather 1031 that investor money back into something else that we can add value again. If you kind of draw that out over a 5-year period. And basically we just give our investors the option. We have some deals that we're just not selling. We're going to hang on to this thing, for the proverbial forever. And then we have another set of deals that we're kind of spinning, we're go in, add value, and then sell. You can compound your earnings pretty substantially over a 5-year period if you've had 3 or 4 sales compared to just holding. And so we want to kind of offer both options that, some of your capital that might be a little bit more risky or want, a little bit more of a high growth. We've got options there as well.
Yeah, no, I believe it, because especially in one thing, or I try to always, even just for myself or anyone asks, what should we be doing? Like, try to not take your chips off the table, so to speak. And we have one deal I think of in particular. It's probably the worst deal we bought, but but it was an office building. We did fine. The returns, it was like a 20 IRR, but it was just like for the time we bought it, like that actually, believe it or not, was like not a great return. I feel like if you bought something in 2009 and then sold it in 2014, but I think on that deal we put $930,000 down on it. So we sold the office building. Then we bought a shopping center. We did a 1031. So you don't pay your tax yet. You defer it. That's what that's what a 1031 is. Then we sold the shopping center and we used the money from that to buy 2 shopping centers. And every year on that 900,000 now, just cash flow and paying the loan down, it's like 700,000 or 800,000 a year. So it's almost like if you look at it that way, this isn't the IRR, but it's like, what's your annual return? It's almost 100, and they're not even including the building going up. So that's what Levi's talking about. And again, like we actually usually the deals we're selling, they're not our nicest ones. This was something where it was this office building. We finally got it full, and we're like, all right, this is like a hot potato. Let's pass it on to the next group and move on with our lives. And we bought a shopping center that was 80% occupied, and did the same thing, filled it up, sold it. And then we bought 2 really nice shopping centers, and those are going to be just longer term holds. So I totally get what you're talking about, because there's some deals where it's like, wow, this is a really good buy and we're going to make a lot of money. But then once you sort of get it worth what it should be, it's not like one that has like a great potential for as much as the others as rent growth or appreciation, or it's an older building. So it makes total sense.
Yeah.
So then going back just kind of to the basics on industrial, then how long are the leases then typically?
5 to 10 years. We just signed a 10 recently. We like the 10-year leases. 10 years with a 3% or 3.5% annual escalation is fantastic. Kind of the bigger and more complicated the building or the use is, the longer the leases are. We're negotiating right now on a big building that'll be a 10-year, and then they've got 2 5-year options with pricing and escalation set already. And so that's really helpful. And that's because that tenant needs to spend about $3 million in tenant improvements in order to make that building, occupiable by them. So,
well, nice. And roughly how big is that building?
That one's 130,000 square feet, where we're typically own kind of in the, 75 to 250,000 square foot. But then we have some industrial parks that we own as well that are, maybe 100,000 square foot altogether, broken into units as small as 1,200 square feet each.
Yeah, but 3 million on that size.
On 100,000 square feet, yes.
Yeah, that's a lot. I'm just doing the math. I mean, they're putting in, $20 some a square foot of their own money. I mean, so that's that's a big chunk of money on that, especially when you look at it per foot. So
yeah, it's interesting from a market perspective. Seeing higher interest rates come in has increased demand from tenants across the board, because at least in Texas, and certainly this is not happening all over the country, but in Texas, the businesses are often still growing or moving here from other states and needing space. And when they go to kind of compare, should we buy or should we rent? Rent is a lot more attractive with a 7 or sometimes 8% mortgage rate.
Yeah, so that's interesting. So how are you seeing? Because I mean, before the name of the game, it seemed like in industrial, let's say, and it might still be, but you almost don't even want to do a long-term lease, or because you want to be able. The rents were growing so fast that no tenant would agree to. In some of these markets, rents were going 5-8% percent, but no tenant's going to agree to that. They'll say we'll do 3 for a 10-year lease, and then when their renewal comes up, if they miss their option to renew, like then the strategy is then you go, okay, we need to reset this to market, and it's been growing at way higher. What are you seeing in the market now? What do you think of that?
My strategy has always been I have a very firm belief that the future is unknowable, and so I don't think yesterday's rent increases necessarily will be what we see tomorrow, and so we would always prefer to have a tenant at today's market rate with a conservative rent escalator in there. And so we've never gone that route where we're looking for shorter leases. In terms of what we're changing strategy wise, or have had to change strategy wise with higher rate debt, which yesterday it just jumped up another 0.75%. So we're kind of deepening this conviction of that this is the right way to go. Is is we're moving away from the stabilized asset purchases that we were making and starting to buy more kind of deeper value add. And we're also starting to look at debt from when I say look at debt, I mean, we are looking at loans that are outstanding right now and seeing if the opportunity exists to maybe buy the loan kind of with a loan to own concept in mind. We would buy the loan, and then if the tenant or the owner of the debt, it can't, kind of cure, then we would own the property.
Yeah. And I mean, a lot of smart people, have pivoted the last 6 months into pref equity. So it's it's basically like a second mortgage,
right.
Just to keep it super simple. And a lot of those, they're, 12 to 14% is probably market on that. And, that's not, you're in a riskier position. So it's not as secure as just the first mortgage. But I think a lot of people look at these deals and go, well, okay, my upside is I make 20%. My downside is I make 0. So if I more or less can get pretty close to a guaranteed 12, I'll just take that. So I've seen a lot of people do that, especially if it's pref, because then, people set those up where they're already right in the entity, as a different share class, and then you don't pay, well, you get kicked out. Now now it's your deal. So so I've seen people move to that. We obviously, like, we're not, we just kind of witnessed that where we haven't borrowed any pref, but makes sense, especially if you're looking at deals where it's like the upside is, as closer to a 12, and you're like, why take the risk? So because deals you're looking at today, then what do you guys, what would make it like a deal you would do then? You looking at like your stabilized yield on cost?
Yeah, I mean, we like them to kind of stabilize around a 9 or a 10 cap after we, kind of go in and add value. And we hope to be able to add that value sooner than later. We just recently bought a building that's a cold storage facility in Houston. It's leased, and we have a 8.2%, I think I've got that right, mid 8% going in cap rate, and 2.5 years remaining on the lease, but the current lease is 35% below market. And so as soon as the lease expires, either the current tenant stays and we raise rent on them, or, we get them out and call it 6 months worth of vacancy and then find another tenant in there at market rate. Added, significant value to the asset. And that one will stabilize around an 11%. So we start.
Okay, nice.
That.
Yeah. So then for you, you're looking more just kind of where can I get this to when I'm able to reset the building to market rents, not so much like a IRR or some other metric.
Yeah. I mean, we obviously have kind of IRR parameters that we feel we need to offer our investors.
Yeah.
I'm a big believer in under promising and over delivering. And so we really want to make sure that we're able to deliver, that to investors. And we very much look at what's the downside. What is the kind of what scenario would exist that would bring this investment to 0 and make it a total loss? Kind of what's the path to that? We really want to understand kind of how bad these things could get. So we call it a pre-mortem, while we're in contract to buy a deal, we sit down as a team and throw out on the whiteboard all of the ways that things could go wrong and what are the mitigating factors, and honestly identify, we try to do this. We try to honestly identify the things that we just can't control, that are just completely outside of our control. And then we just disclose those to investors and say, I mean, here's the way this thing could go to 0. And here's, kind of what we can do about it. But here are things that we just can do nothing about.
Yeah. And what sort of things come up when you do that for these type of deals?
It kind of depends, on a multi-tenant deal, there's a lot less risk that could happen. On a big single tenant deal, there's certainly a lot more of that we look at. Certainly in our Houston properties, a thing that often ends up pretty high on the list is what if oil prices were to crash, and a bunch of the oil companies who currently occupy buildings all around the Houston market start to panic and need to rent space, and they, kind of shut down a bunch of facilities, that they're in this terrible position and have to dump it on the market. They don't care if, you're renting, if they're going to turn around and sublease into a market that's typically charging $1 per square foot per month, they're going to put it for 60 cents a month because they don't care.
Yeah,
they
just dump it
to get it out there. Kind of similar to the situation that's going to start happening here in Austin with There's a big tower that Facebook had leased that just yesterday it was official that they're going to sublease it. It's an enormous amount of space.
Yeah, I saw that this morning with the square footage, so I wouldn't normally know this, but I think I said 590,000 square feet is what they were going to take in a single building. They were going to take like an entire tower basically that's being built, and now they're they took like a $3 billion they just charge however that works with public companies where they so like a lot of these leases they can't just like get out of them, so they're just now going to try to sublease. So to your point, if they were going to pay $25 a foot in rent, now let's just dump this thing at 18 and move on with our lives. So now the whole Austin office market has to deal with that. So
especially a public company. I mean, they like to have a bunch of profitable quarters and then just get all the pain over with in one really crappy quarter. And so they try to throw in as much as they can in that quarter. If they which it might be the smarter thing from a financial perspective for them to draw it out and just slowly lease this thing up at market rate and kind of maintain that, high lease rate so that they minimize their loss. It's actually not in their best interest. So they would rather just, take a beating on their stock and say, hey, we're writing this thing down completely right now. We're setting aside these funds. Here's how it's going to go. And we're just going to get tenants in here. We don't care if it's a total loss or not total. We don't care if it's a significant loss. Which is not helpful to the market as a whole.
Right. Where if they could just treated it more like the owner would have, where, all right, let's just rent this thing up over the next 2-3 years, and then we'll get like respectable rents here. That would, they would come out with more money, but it's like, no, let's just try to get this all in this quarter. We're already struggling enough with the metaverse and everything else. So let's just be done with it.
Yeah, I mean, all that to say that's one of our biggest risks is that oil, although from a macro perspective, I don't think that's likely because, there's a lot of kind of international geopolitical reasons why U.S. energy independence is increasingly important. And we're probably going to keep producing here locally for a long time. And so I don't think that market's going to crash, but it certainly could. It has many times in the past. Oil very rarely makes sense, the directions that it heads.
Yeah, so, it's going to do something you think it's not. That's how oil works. So whatever. Yeah. But that would be definitely a risk. But I like the way you're going about it, where these are so the cap rates you're able to stabilize to are so much higher than where the market is. You've got a lot of sort of margin of safety built in there, or whatever you want to call it, margin of error, where rents drop 30%. Well, then you're actually just going to re-rent it for the rent you're already getting on that deal, and it was already an 8 cap. Interest rates are, at least they're not 8 yet. We're
the other big thing that we look at, and they all kind of interplay together, but just is the replacement cost. And so, for instance, that is almost 100,000 square foot building, the cold storage one that I mentioned earlier. We bought it at $91 a square foot, and cold storage of that quality in that location costs about $250 a square foot to build today. And so we've got a major buffer there, and right now
no
cold
new supply
storage
coming then.
Yeah. And cold storage, I mean, there's like a single, very low single digit, like 2% or something vacancy rate. It's not going to all of a sudden be a bunch of new cold storage on the market. So we feel very well secure.
Yeah. Or at least whatever new supply is going to come. I mean, they have to charge like almost, at least double what you need. Because if you're in at 90 a foot and they got to be 200 plus, I mean, so they need to be getting double the rent. So there's a lot of room where you're not going to have competition at the rents you're talking about in terms of new properties coming online.
Yeah,
so
certainly.
One thing that's definitely different with industrial and all the commercial property types is triple net leases. So typically, is that what you guys are doing then, or?
Always, yeah. We definitely don't like anything other than triple net leases. So basically, that just means our rent is secure, and then our operating costs pass through to the tenant, and so they have a variable operating cost. Basically, their rent is variable, so they pay for insurance and property taxes on the building and any operating costs that we have, like landscaping, maintenance, things like that. And so we just pass all that through to them. If there's a property tax increase, which we've had quite a few lately. We've had one building that it went up, it literally doubled this year, which is certainly disappointing, but we're able to pass that through to the tenants.
Yeah. So contractually,
part of their rent.
Yeah. Contractually in these leases, they pay, all the operating costs back to Levi. And then, right. So when there's a property tax increase that's passed on to the tenant. So it doesn't impact Levi's, net operating income on that deal. They'll all be complaining a lot when it comes up time to renew their lease though. Cause the tenants do look at their total rent, the gross rent when they're figuring out what does this place cost me. But if you're locked in a 10-year lease and your property tax is double in year 3, there's really not anything they're going to be able to do.
Nothing they can do. I mean, that said, we always fight quite a bit on property taxes, and we've got a company basically on retainer that goes and fights those for us. And we definitely beat them up and try to get those as low as possible. Yeah. I
mean, Texas and Illinois are pretty similar where you've got to just basically appeal every year is the name of the game. At least they, it's weird in Texas. The sale prices are undisclosed, and in Illinois by law, you can't chase the sale. So they know the sale, but they have to ignore it. It's weird. But then when you appeal, they kind of do. It's like how they use it is like, okay, you bought this building, and then that brings up maybe all the other ones, but they don't just chase it 1-to-1 like in a lot of states where it's like you paid $10 million, your assessed value should be $10 million now. So
right. Yeah.
But that's great. I mean, because then in terms of, everyone, it's inflation and interest rates are what's on everybody's mind. And at least within industrial and these commercial property types, you've got all the operating costs, property tax changes, increases. Those are all passed 100% on to the tenants. What about, sometimes CapEx is not, so they'll have a roof carved out of that or something. So, I mean, when you buy these deals, Levi, what do you normally looking at for big items on the purchase besides the tenant? You're checking what sort of things on this?
So the two things that we always remain on our costs on those leases is roof and structure. So if something were to happen to the foundation and we needed to repair that, we can't pass that through to the tenant. And then if the roof starts leaking, we have to come in and fix that. So it matters to us. I mean, not that it wouldn't matter anyway, even if we were passing that through to the tenant, but it really matters to us how the quality of the roof. So we've got a roofing company that goes out on any asset that we're looking at, and they do a very thorough inspection and tell us what it's going to take to basically come in and replace that roof. And if it's 15 years old, we figure on a pretty major CapEx budget right up front to bring it up. Even it might be a 30-year roof, but about 15 years is when you start to see the leaks, and it's kind of nothing worse than the stock that gets ruined because of the roof leaked. And so we try to be really careful on that front.
What roofing types most common on these buildings, would you say?
TPO, it's those white roof that's reflective and that's
simple. A newer material in a lot of places. So then even in Texas that was being used 15 years ago, or that's what you're putting on now if you got to
That's what we're putting on now. A lot of them will have a metal roof on there, which some of those metal roofs will last 50 years, and that is great. But when we replaced it, almost always the best financial move is a TPO.
The last few that we've done, if they're in the Midwest, it's all been TPO. Arizona's we got some deals there. It's a totally different roof type where it's too hot to use a regular roof almost, where they have a different setup where they, it's not TPO. It's like a buildup of almost like a foam paint. So it's interesting. So, but great. Yeah. I think then what would you say then, what do you feel like the next, let's say 12 months or so is going to be bringing in the industrial market? Because I'd say multifamily, we've definitely seen that cool off. Obviously rents weren't going to grow for 20% every year, so no one was expecting that. But we've seen things, flatten out where your average person, they're worried about inflation, and then now they kind of are feeling things tightening up on them, so they're not. They're not moving as much. I feel like so everyone's doing great with renewals, but it's been harder to push rents. you are locked in on existing leases,
Right.
with whatever the increases are. But on new ones, I mean, how do you feel like rents have moved? Let's say the last whatever time frame you think makes sense, 6 months, and how do you feel like the next year is going to look?
Yeah, I mean, we're still seeing rent increases. I think sentiment has shifted to the downside. There's certainly a little bit more fear, especially in our smaller businesses. The bigger ones are looking at their orders and saying, "Hey, we still need more inventory. We need more space in order to deliver on the orders that we're seeing." I think sentiment shifting means that you kind of have these odd little pauses where it's like, "Oh my gosh, interest rates went up and the stock market went down," and it'll quiet out for a little bit. It's funny; it comes in waves, and it seems like there's these like 3-week cycles where it'll be real quiet. We won't hear from new tenants looking to lease, and then all of a sudden we'll have 8 showings in one day and get a couple of leases signed. It's kind of odd. But that said, I mean, there's not enough space in the market, and it costs more by a pretty substantial margin to build compared to the value of everything that we've got in our portfolio. And so I feel real safe and secure where we're sitting, and we have large reserve funds on all our deals. So certainly feel like we're in a good spot, and we're buying. We're absolutely net buyers. We've sold a couple of deals, but I mean, we're seeing more and more opportunities come through our pipeline, and some are pretty substantial, 30-40% below market rents, and buying on current, a decent cap rate on current income, and we'll buy that all day long. So.
Yeah. And so how have you shifted anything in your strategy then recently, just given how the economy, interest rates?
Yeah, we're using less debt and passing through, we are increasing our pref rate to investors. And so we're basically just saying, hey, I'd rather pay you a higher pref rate and raise a little bit more capital on a deal and use less debt so that our debt service coverage ratios are better. We've got I think it's like a 1.4x global debt service coverage ratio across our portfolio, which makes me feel very comfortable. But on our new deals, we're even being more conservative than that. And so
nice. Yeah. And this, for the folks that don't know, 1.4 debt cover, all that would mean is the income from the properties is after all the expenses is 140% of what the mortgage payments would be, principal and interest. So there's 40% extra there for stuff to go wrong or cash flow to pay out. So
certainly.
But nice. Then what? So then on your deals, when you said you increased the pref, that's like the preferred return to the equity, or you do a piece that's actually like pref where it's all they get is that return?
No, that's we don't do kind of layered, mezz debt or mezz kind of pref equity, but that's just the preferred return. So we have one pool of investors that come in, and we pay them either 6, 7, or 8% preferred return, annual return on their equity that's in the deal. So if we have, call it $10 million of equity in a deal, then we owe them $600,000, $700,000, or $800,000 a year of kind of the first income that comes out of that deal. Distributable cash flow goes to pay that off before we start to participate in the property or in the distribution. So basically, it's just helps investors be comfortable that as long as this thing performs even somewhat, I've got this kind of base, kind of low water mark that it won't go below. I mean, I guess it certainly can go below that. As we said, there are risks that we can't control, but assuming things aren't terrible, they're going to still be doing a decent return on their capital.
Yeah, I know what you mean. Where it's not a guaranteed return, but they get that before there's any sort of like profit share incentive fee to harbor capital. Right. So they know like before, at least if the deal makes it, I'm getting this before we're splitting anything. So it's like
exactly.
Makes sense. But I think it's interesting, just every trend is in Texas's favor. So I'm not surprised to hear what you're saying. A lot of these relocations, like they announce them like a business relocation, but they don't just move immediately. It's like they announced it in 2020, but they actually are going to move in 2023. So then they're still ringing Levi's phone, or your brokers, I guess, probably, but about moving.
Certainly.
So that all makes sense. And so I got the reasons why you invest in it. We have a lot of passive investors that listen and watch. So what would you say like your investors are looking for? Because I think they're probably not saying, I like how high the untrended yield on cost is, or what we were talking about before. This is like they're looking at this from a different angle. So what have you heard? What do they like about investing in industrial?
Yeah, I think if you don't mind, I want to answer with a kind of an odd. I want to go a different direction with it. I wrote a thread the other day. I don't know if you saw it about Texas. Do you mind if I read that?
Yeah, just go ahead.
Let me read that. I've got it open here.
Okay.
I basically have been doing a bunch of research trying to figure out why, because I've got a bunch of other, there's a peer group of other industrial investors that I know and I'm often, interacting with, and they're all kind of giving me a different read on what their markets are doing in Indianapolis or, Florida or wherever else they own assets. And so I was trying to figure out like, what is it about Texas that makes it special? Because I want to understand kind of why we're, why this still works and does this have legs, right? Is this just a temporary little boom, or is this something that kind of can continue to run long term? So I'm gonna read this.
Let's go.
2 minutes here. Yeah. All right. We need to talk about what's happening in Texas. From the manufacturing the goods of the future standpoint, the Texas Triangle, meaning Dallas, Fort Worth, Houston, and San Antonio, finds itself sitting in an unparalleled position, boasting cheap food, cheap power, laughably light regulatory oversight, cheap land, no income tax, minimal corporate tax, and yet I'm just getting started. Attracted to the state like flies to a flood lamp at night, American manufacturers from all sectors keep pouring in, from aerospace to automotive to oil processing and semiconductors. It's a dynamic geographic triangle that leverages the strength of each urban core. Austin operationalizes Silicon Valley's ideas, while Dallas-Fort Worth leverages its banking prowess and skilled labor pool to turn out manufacturing equipment. San Antonio mixes even lower costs than the Texas average with the tech of Austin and capital of Dallas to churn out anything that could be put on an assembly line. Don't even get me started on Houston. It plays with Austin in tech, Dallas in automation, and San Antonio in manufacturing, and it's a financial capital. And it is a financial capital, not to mention that it is one of the world's largest energy hubs that happens to be conveniently located off the Gulf Coast, boasting America's largest port by value, second only to Germany in machine shop tech. And oh yeah, by the way, Houston is the second largest concentration of Fortune 500 headquarters in the world. The Texas Triangle is only one of a few regions in the world that could practically stand alone without the help or trade of its neighbors, yet it does not have to. It's situated in the heart of America, which has ports on three sides, the most arable land of any country in the world, friendly neighbors, energy independence, and the largest military and current guts to start raising interest rates when the rest of the world is keeping the cheap debt party going down the road, only deepening the pain of their eventual hangovers. As the world changes around us, it's hard not to belong America and impossible not to belong Texas.
So there we go. Even getting the military into that.
That's right.
Yeah, that. Yeah, but that makes there's so much momentum there. I mean, you think about it, over half. This is at least what it feels like. Over half the relocations, when you hear them announced, where all the companies that have bailed on California and these other places, it's half are one of those Texas cities, and then the rest gets spread out basically on the rest of the Sun Belt. Tennessee, Arizona, Florida pick up a ton. For a lot of the same reasons, but they, Texas is, especially for industrial, it's right in the middle of everything.
Absolutely.
And probably, for a lot of these businesses, I just actually watched a video where Puma is opening a new warehouse. They wanted it to be in California. They couldn't find any space in the Inland Empire. And they're like, you know what? We're just going to open it in Phoenix. It's like a 6-hour drive, but it's like a third of the price or something like that. And
right.
The guy who was talking about from Puma is like, you can either be close to your customers or close to the port. Mm-hmm. And it's too expensive to be close to the port. It's basically like to keep it simple. So now, you pick up, you move to DFW or something, and now you're right in the middle of the country with, and it's not, and there's so many people there. If you add up the population of those cities you just mentioned, those four, I mean, that's got a, rival just like, the Northeast or SoCal.
And the Houston port was never, pre-COVID, the Houston port wasn't a major, I mean, obviously it's a big port, but it wasn't like a major kind of inlet of goods from international suppliers, exporters, or, importing into America. But post-COVID, it's doubled and maintained that double amount of volume coming through the port. So it's just a lot more, just goods and services coming into town here. So
yeah. So that's why Texas. Now let's answer the investor question. Why do these LPs jump in your deals? What are they thinking about? It's for cash flow, or
most of them are looking for, basically there are a lot of LPs who have invested in a lot of real estate and done well over the last 10 years and are looking for a way to keep the party started. And industrial is a very good, safe, long-term bet. And the way we structure our deals and have this open, honest communication about kind of how bad things could get and what we're doing to mitigate that, I think is attractive. And so we're thankfully in the position right now where we have about 5 times as much equity capital available as deal flow. And so we're trying to get that deal flow up.
Yeah, I mean, that's one thing too, where that's, good on you, Levi, and I'm in the same position where like I'm probably the bottleneck on the deals because I don't want to do any bad deals. So if if it doesn't, nothing. Yeah, I feel like there's where we need to be the gatekeepers for a lot of these investors, where we don't want to push out a bad deal just to make like a quick buck. I mean, they're checking over the deals obviously, but we do this every day, so we know. Just have a lot more expertise in this. So then we kind of see all the places things can go wrong and don't want to, just be pushing deals to push deals. So not surprised to hear that.
Yeah. A reputation is everything.
How can people get in touch with you? If anyone, they like what they heard, they want to kind of see what Levi's up to, where should they go?
Yeah. So I'm on Twitter at Levi James here is my handle on Twitter. And then harborcap.com is our website. You can sign up there to see our deal flow. And if you're an accredited investor, welcome to take a look at our deals and invest in them. So
perfect. And they can just sign up right on the list, right on the website.
Yeah. And if, we basically have a qualification process and then we approve it on the back end. So
perfect. But nowhere else, no need to go somewhere else. You just write all on the website. So
Right.
Well, thanks, Levi.
Yeah. Thank you. Appreciate it.
Until next time, everyone. Thanks for joining us, and we'll see you on the next episode. Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings, LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.